I think I'm live on the YouTube now. All right. All right. So, like I said, we are reading the instructions of the 709. Um, welcome in. Hey, Kali. Welcome in. Welcome in, Freedom. Freedom. Um, about to start the reading. Now, we left off. We left off at. Let me just say. Okay, so let me start like this. Where we are is we're under the subheading Schedule A, Computation of Taxable Gifts. And underneath that subheading, we are at determining the generation of a donee. I recommend, as always, for y'all to read the same thing that I'm reading. We are not CPAs. We don't have no financial advice for none of you. We don't offer that. That's not something that we do. We don't offer financial advice, legal advice. We don't even tell you what color your clothes should be. We don't offer no advice. Okay, so get that through your head, and hope the whoever the people out there to give your account strikes understand what we're saying here. We do not offer advice. All right. What we do is we read, and if we have questions, we write them down, and we ask the questions. It's that simple. So we're gonna pick up the reading. Determining the generation of a donee. Generally, a generation is determined along family lines as follows. Number one, if the donee is a lineal descendant of a grandparent of the donor, for example, the donor's cousin, niece, nephew, etc. For the number of generations between the donor and the descendant, donee, is determined by subtracting the number of generations between the grandparent and the donor from the number of generations between the grandparent and the descendant, the donee. Number two, if the donee is a lineal descendant of a grandparent, of a spouse, a former spouse of the donor, I'm sorry, let me read that again. If the donee is a lineal descendant of a grandparent of a spouse or former spouse of the donor, the number of generations between the donor and the descendant, donee, is determined by subtracting the number of generations between the grandparent and the spouse or former spouse from the number of generations between the grandparent and the descendant, donee. Number three, a person who at any time is married to a person described in number one or number two above is assigned to the generation of that person. A person who at any time is married to the donor is assigned to the donor's generation. A relationship, number four, sorry. A relationship by adoption or half blood is treated as a relationship by whole blood. A person who is not assigned to a generation according to number one, number two, number three, or number four above is assigned to the generation based on the person's birth date as follows. Number one, a person who was born not more than 12 and a half years after the donor is in the donor's generation. Number two, a person born more than 12 and a half years, but not more than 37 and a half years after the donor is in the first generation younger than the donor. Number three, similar rules apply for a new generation every 25 years. If more than one of the rules for assigning generations apply to a donee, that donee is generally assigned to the youngest of the generations that would apply. If an estate, trust, partnership, corporation, or other entity other than governmental entities and certain charitable organizations and trust described in sections 511A2 and 511B2, as discussed later, is a donee, then each person who indirectly receives the gift through the entity is treated as a donee and is assigned to a generation as explained in the above rules. Charitable organizations and trust described in sections 511A2 and 511B2 and governmental entities are assigned to the donor's generation. Transfers to such organizations are therefore not subject to the GST tax. These gifts should always be listed in Part 1 of Schedule A. Generation assignments under Notice 2017-15. Notice 2017-15 permits a taxpayer to reduce the GST exemption allocated to transfers that were made to or for the benefit of transferees whose generation assignment is changed as a result of the Windsor decision. A taxpayer's GST exemption that was allocated to a transferee or a trust for the sole benefit of such transferee, whose generation assignment should have been determined on the basis of familial relationship as a result of the Windsor decision, and are non-skip persons, is deemed void. For additional information, go to irs.gov/business/small business self-employed/estate and gift taxes. Charitable remainder trust. Gifts in the form of charitable remainder annuity trust, charitable remainder. Sorry, let me read that again. Gifts in the form of charitable remainder annuity trust, charitable remainder uni trust, and pooled income funds are not transfers to skip persons and are therefore not direct skips. You should list these gifts in Part 1 of Schedule A if none of the life beneficiaries are skip persons. If a life beneficiary is a skip person, list these gifts on Part 3 of Schedule A. Generation assignment, where intervening parent is deceased. If you made a gift to your grandchild, at the time you made the gift, the grandchild's parent, who is your or your spouse's or your former spouse's child, is deceased, then for the purposes of generation assignment, your grandchild is considered to be one of your children rather than your grandchild. Your grandchild's children will be treated as your grandchildren rather than your great-grandchildren. Oh, shucks. I forgot to put the... Hold on. I'm going to lose my place. This rule. Okay. I forgot to show the comments on here. Show comments on page. Boom. All right, my bad. Let's get back to it. This rule is also applied to your lineal descendants below the level of grandchild. For example, if your grandchild is deceased, your great-grandchildren who are lineal descendants of the deceased grandchild are considered your grandchildren for purposes of GST tax. This rule may also apply in other cases of the death of a parent of the transferee. If property is transferred to a descendant of a parent of the transferor, and that person's parent, who is a lineal descendant of the parent of the transferor, is deceased at the time the transfer is subject to gift or estate tax, then for purposes of generation assignment, the individual is treated as a member of the generation that is one generation below the lower of the transferor's generation or the generation assignment of the youngest living ancestor of the individual who is also a descendant of the parent of the transferor. The same rules apply to the generation assignment of any descendant of the individual. This rule does not apply to a transfer to an individual who is not a lineal descendant of the transferor, if the transferor at the time of the transfer has any living lineal descendants. If any transfer of property to a trust would have been a direct skip except for this generation assignment rule, then the rule also applies to transfers from the trust attributable to such property. 90-day rule. For assigning individuals to generations for purposes of GST tax, any individual who dies no later than 90 days after a transfer occurring by reason of the death of the transferor is treated as having predeceased the transferor. Let me read that again. That was a mouthful. Okay, 90-day rule. Welcome in. Looks like we got a couple more people. Welcome in, Letitia. Letitia or Letitia? Sorry if I said that wrong. Welcome in, Roger Troutman. That's a famous name. Welcome in, Henry. And anybody else I forgot while I'm reading. Welcome in. All right. 90-day rule. For assigning individuals to generations for purposes of the GST tax, for any individual who dies no later than 90 days after a transfer occurring by reason of the death of the transferor is treated as having predeceased the transferor. The 90-day rule applies to transfers occurring on or after July 18th, 2005. See Regulation Section 26.26 2651-1A23 for more information. Examples. The GST rules can be illustrated by the following examples. Example 1. Hold on, guys. Hold on. Oh, man. I'm in here by myself today, so I gotta do everything by myself. And I forgot to take the trash out. All right. My bizzle. My bad. Okay. All right. I'm back. Sorry about that. Did not want to not have my trash out. All right. You're gonna have to forgive me for snacking. I get off work and I come straight to do this for y'all, so I don't have a I don't have a moment to pause in between. But it still gets snacky. All right. Can't be everywhere at the same time, but doing our best. Invited to invite to join guests. Welcome in Gen X 73. Welcome in Michael. Welcome in Lady T. Welcome in Curious. Glad to have you guys in. Sorry for the delay. I know it seems kind of a little chaotic. I'm definitely not one of these podcaster people, but I'm gonna get through this reading for y'all because I said I was gonna do it. So, with the pauses and the breaks to take the trash out and grabbing something to drink, I'm still gonna get through this here. So we are at the 90-day rule, and they're giving us an example. Okay, examples. The GST rules can be illustrated by the following examples. Example number 1. You give your house to your daughter, with the remainder then passing to your daughter's children. This gift is made to a trust, in quotation marks, even though there is no explicit trust instrument. The interest in the property transferred, the present right to use the house, is transferred to a non-skip person, your daughter. Therefore, the trust is not a skip person because there is an interest in the transferred property that is held by a non-skip person. And the gift is not a direct skip. The transfer is an indirect skip. However, because on the death of your daughter, a termination of your daughter's interest in the trust will occur, that may be subject to the GST tax. See part 3 later for a discussion on how to allocate GST tax exemption to such a trust. Example 2. You give $100,000 to your grandchild. This gift is a direct skip that is not made in trust. You should list it in part 2 of Schedule A. Example 3. You establish a trust that is required to accumulate income for 10 years and then pay its income to your grandchildren for their lives, and upon their deaths, distribute the corpus to their children. Because the trust has no current beneficiaries, there are no present interests in the property transferred to the trust. All of the persons to whom the trust can make future distributions, including distributions upon the termination of interest in property held in trust, are skip persons. That is, your grandchildren and great-grandchildren. Therefore, the trust itself is a skip person, and you should list the gift in part 2 of Schedule A. Example 4. You establish a trust that pays all of its income to your grandchildren for 10 years. At the end of 10 years, the corpus is distributed to your children. Because for this purpose, interest in the trust are defined only as present interest. All the interests in the trust are held by skip persons. The children's interests are future interests. Therefore, the trust is a skip person, and you should list the entire amount you transferred to the trust in Part 2 of Schedule A, even though some of the trust's ultimate beneficiaries are non-skip persons. Part 1, gift subject only to gift tax. List in Part 1 gift subject only to the gift tax. Generally, all the gifts you made to your spouse that are required to be listed, as described earlier, to your children and to charitable organizations that are not subject to the GST tax, and should therefore be listed only in Part 1. Hold on. What? Okay, hold on. I was about to say, what did? All right. I thought I read something that was crazy. All right, I'm gonna keep going. Sometimes I'll be wanting to stop and just be like, "Did y'all read that? Did y'all read that?" But I'm gonna keep going. Well, because we're not that far. We're not that far in. Nobody got no questions yet, right? No questions. I don't see no questions popping up. All right, bet. We'll keep going. Group the gifts in 4 categories: gifts made to your spouse, gifts made to third parties that are to be split with your spouse, charitable gifts, if you are not splitting gifts with your spouse, and other gifts. If a transfer results in gifts to 2 or more individuals, such as a life estate to one with remainder to the other. Hold on, let me read it again so it's not confusing. Sorry. If a transfer results in gifts to 2 or more individuals, such as a life estate to one with remainder to the other, list the gift to each separately. Number and describe all gifts, including charitable, public, and similar gifts, in the columns provided in Schedule A. Columns B through D. Describe each gift in detail so that the property can be easily identified, as explained below. For real estate, give a legal description of each parcel, a street number, name, and area if the property is located in a city, and a short statement of any improvements made to the property. For bonds, give the number of bonds transferred, the principal amount of each bond, the name of obligor, date of maturity, rate of interest. I'm sorry, not interest. Rate of interest. Date or dates when interest is payable. Series number if there is more than one issue. Exchanges where listed, or if unlisted, give the location of the principal business office of the corporation. And Committee on Uniform Securities Identifications Procedure number, that is CUSIP number. The CUSIP number is a 9-digit number assigned by the American Banking Association to traded securities. For stocks, give number of shares, state whether common or preferred. If preferred, give the issue, par value, quotation at which returned, and exact name of corporation. If unlisted, on a principal exchange, give the location of the principal business office of the corporation, the state in which incorporated, and the date of incorporation. If listed, give principal exchange and CUSIP number. For interest and property based on the length of a person's life, give the date of birth of the person. If you transfer any interest in a closely held entity, provide the EIN of the entity. For life insurance policies, give the name of the insurer and the policy number. Clearly identify in the description column which gifts create the opening of an ETIP, as described under transfers subject to estate tax inclusion period earlier. Describe the interest that is creating the ETIP and an allocation of, describe the interest that is creating the ETIP. An allocation of GST exemption to the property subject to an ETIP that is made prior to the close of the ETIP becomes effective no earlier than the date of the close of the ETIP. See Schedule D, computation of GST tax later. Column E, donor's adjusted basis of gift. Show the basis that you would use for income tax purposes if the gift were sold or exchanged. Generally, this means cost plus improvements, less applicable depreciation, amortized. Start over, sorry. I'll be tired, y'all. All right. Show the basis you would use for income tax purposes if the gift were sold or exchanged. Generally, this means cost plus improvements, less applicable depreciation, amortization, and depletion. For more information on adjusted by basis, see publication 551, Basis of Assets. Columns F and G, date of gift and value at date of gift. The value of a gift is the fair market value, FMV, of the property on the date the gift is made, valuation date. The FMV is the price at which the property would change hands between a willing buyer and a willing seller. When neither is forced to buy or sell, and when both have reasonable knowledge of all relevant facts. FMV may not be determined by a forced sale price, nor by the sale price of an item in a market other than which, let me say that again, sorry. FMV may not be determined by a forced sale price, nor by the sale price of the item in a market other than that in which the item is most commonly sold to the public. The location of the item must be taken into account whenever appropriate. The FMV of a stock or bond, whether listed or unlisted, is the mean between the highest and the lowest selling prices quoted on the valuation date. If only the closing selling prices are available, then the FMV is the mean between the quoted closing selling price on the valuation date and on the trading day before the valuation date. If there were no sales on the valuation date, figure the FMV as follows. Find the mean between the highest and lowest selling prices on the nearest trading date before and the nearest trading date after the valuation date. Both trades must be reasonably close to the valuation date. Prorate the difference between mean prices to the valuation date. Add or subtract, whichever applies, the prorated part of the difference to or from the mean price figured for the nearest trading date before the actual valuation date. If no actual sales were made reasonably close to the valuation date, Make the same computation using the mean between the bona fide bid and the asked prices instead of sales prices. If actual sales prices or bona fide bid and asked prices are available within the reasonable period of time before the valuation date, but not after the valuation date, or vice versa, use the mean between the highest and lowest sales prices or bid and ask prices as the FMB. Stock of closed corporations or inactive stock must be valued on the basis of net worth, earnings, earning and dividend capacity, and other relevant factors. If no actual sales were made, I'm going to jump back. Generally, the best indication of the value of real property is the price paid for the property in an arm's length transaction on or before the valuation date. If there is no such transaction, use the comparable sales method. In comparing similar properties, consider differences in the date of sale and the size, condition, and location of the properties, and make all appropriate adjustments. The value of all annuities, life estates, terms for years, remainders, or revisions is generally the present value on the date of the gift. Sections 2701 and 2702 provide special valuation rules to determine the amount of the gift when a donor transfers an equity interest in a corporation or partnership, Section 2701, or makes a gift in trust, Section 2702. The rules only apply if immediately after the transfer, the donor or applicable family member holds an applicable retained interest in the corporation or partnership, or retains an interest in the trust. For details, see Section 2701 and 2702 in their regulations. I don't know about y'all, but I can't wait to get to there. Just like we couldn't wait to get to these definitions to understand what they were talking about earlier, I can't wait to get to 2701, 2702. Whenever I'm reading something, and it's just me, this is not advice. We don't give advice. TikTok don't strike us for reading. Damn, what was I about to say? Oh, when I'm reading, I think I said this on the last video too. I'm gonna say it for this video just for prosperity. When I'm reading something, right, and I see on the first page they reference whatever it is, okay? They reference, I could be reading this thing of water, whatever it is I'm reading, and it keeps referencing something. Or there's some symbolism. Like you pick up this water and it's a symbol on there. And then you see that symbol somewhere else. And then you see that symbol somewhere else, right? You should ask questions. You should ask questions. What is this? What is this circle with the U on my water? What does that mean? You should ask questions. When I'm reading through this and it keeps saying C2701, C2702, keep C2701, C2702, C20, bruh, ask questions. That's way too many times that you keep referring to that. That has to be significant, right? It has to be significant. Why would they keep saying it? It's the same thing with this bottle of water. I got to turn the thing around so I'm not advertising. It's the same thing with this bottle of water. It is no different. On this bottle of water, they got a bunch of symbols. You done seen them symbols hundreds of times in your life. And if you ain't never asked what that symbol was, then you're foolish. Sorry. But if something is interacting with you in your life on a consistent basis, you should ask questions. At the least. But if you're reading something, you absolutely must ask questions for something that's consistently presented to you. over and over again in the reading, especially if you don't know what it is. And I'm going to admit, I don't know what this, I don't know nothing. I don't know nothing. I'm just reading. So when I come across something I'm reading and I don't know what it is, I'm going to keep asking questions. What does that mean? But if I see it consistently over and over and over again, come on. Come on. Your brain should be clicking. Something should be happening in there. A question should be forming. Okay? All right, I'm going to keep going. Where we at? So look at this now. The mean between. Okay. Yeah, it's not close. Okay. Properly. All right. Did I read that already? Yeah. Column H. Picking up at column H. Sorry about that. Column H. Split gifts. Enter an amount in this column only if you have chosen to split gifts with your spouse. Split gifts. Gifts made by spouses. If you elected to split gifts with your spouse and your spouse has given a gift that is being split with you, enter in this area of part 1 information on the gift or gifts made by your spouse. If you made gifts and you're splitting them with your spouse, do not make any entry in this area. Generally, if you elect to split your gifts, you must split all gifts made by you and your spouse to third-party donees. The only exception is if you gave your spouse a general power of appointment over a gift you made. Supplemental documents. To support the value of your gifts, you must provide information showing how it was determined. For stock of close corporations. All right, hold on. Close or close? And that okay. See, I just did it. I just came across a paragraph that, as I'm reading, I'm trying to pre-read a little bit so it can be more clear when I'm reading to the microphone. So I'm trying to read ahead a little bit, but I came across something that the word could be close or close. So I had to read it twice. And I had to gain, it's my first time reading this. So I have to gain information from the surrounding paragraph. The paragraph says, for stock of close corporations, is what I thought, or inactive stock, attach balance sheets. Well, close corporations doesn't make sense when you say inactive stock. Close corporation makes more sense when you say close. So then I read it again. For stock of closed corporations or inactive stock, okay, now that makes sense. Even though I don't know none of this, I can at least read. That's what I can do. That's the minimum. We can do this. We can read. And if we come across something, like I just said, that word could be used either way. So I'm like, oh man, what the heck are they talking about? Use the words around it. Oh, okay. Yeah, that makes more sense. I'm not saying this stuff is going to be easy, y'all, but we should at least avail ourselves to these things, these publications and things. That they're free. They're for you to use. Why not learn it? It ain't gonna hurt nothing, and you might help somebody, including yourself. Welcome in, family. Welcome in. Welcome in, Franklin. Welcome in. It looks like Wes. Welcome in, Brandy. We're reading the 709 instructions. If you don't know, guess what we doing over here. All right. Where are we at? Split gifts, supplemental documents. All right, so I was reading and I got tripped up by that word. So let me go back and try to make it clearer. For stock of closed corporations or inactive stock, attach balance sheets, particularly the one nearest the date of the gift, and statements of net earnings or operating results and dividends paid for each of the 5 preceding years. In lieu of this information, you may attach an appraisal described in Regulation Section 301.650C-1F3. Excuse me. For each life insurance policy, attach Form 712, Life Insurance Statement. Note, for a single premium or paid up policies. In certain situations, for example, where the surrender value of the policy exceeds its replacement costs, the true economic value of the policy will be greater than the amount shown on line 59 of Form 712. In these situations, report the full economic value of the policy on Schedule A. See revision. See revision rule 78-137, 1978-1, CB 280 for details. If the gift was made by means of a trust, attach a certified or verified copy of the trust instrument to the return on which you report your first transfer to the trust. However, to report subsequent transfers to the trust, you may attach a brief description of the terms of the trust or copy of the trust instrument. Also, attach any appraisal used to determine the value of real estate or other property. If you do not attach this information, Schedule A must include a full explanation of how value was determined. Part 2, direct skips. List in Part 2 only those gifts that are currently subject to both the gift and GST taxes. You must list the gifts in Part 2 in chronological order that you in. Read that again. Sorry about that. You must list the gifts in Part 2 in the chronological order that you made them. Number, describe, and value the gifts as described in the instructions for Part 1. If you made a transfer to a trust that was a direct skip, list the entire gift as one entry in Part 2. Column J, Section 2632B, election out. If you elect under Section 2632B(3) to not have the automatic allocation rules of Section 2632B apply to a transfer, enter a check in column J next to the transfer. You must also attach a statement to Form 709 clearly describing the transaction and the extent to which the automatic allocation is not to apply. Reporting a direct skip on a timely filed Form 709 and paying the GST tax on the transfer will qualify as such a statement. How to report GSTs after the close of an ETIP. If you are reporting a GST that was subject to an ETIP, provided that the ETIP closed as a result of something other than the death of the transferor, see Form 706. Do not include the transfer subject to an ETIP on a Schedule A. Rather, report the transfer subject to an ETIP on Schedule D. See Schedule D, Part 1, Generation Skipping Transfers later. Report all other gifts made during the year on a Schedule A as you normally would. Split gifts, gifts made by spouse, See this heading under Part 1. Part 3, indirect skips and other transfers in trust. Some gifts made to trust are subject only to gift tax at the time of transfer, but may later be subject to the GST tax. The GST tax could apply either at the time of the distribution from the trust, at the time of termination of the trust, or both. Section 2632C defines indirect skips and applies special rules to the allocation of GST exemption to such transfers. In general, an indirect skip is a transfer of property that is subject to a gift tax other than a direct skip and is made to a GST trust. A GST trust is a trust that could have a GST with respect to the transferor, unless the trust provides for certain distribution of trust corpus to non-skip persons. See Section 2632C 3B for details. List in Part 3 those gifts that are indirect skips as defined in Section 2632C or may later be subject to the GST tax. This includes indirect skips for which election 2 described below will be made in the current year or has been made in a previous year. You must list the gifts in Part 3 in chronological order that you made them. Column N, Section 2632C, election. Section 2632C provides for the automatic allocation of the donor's unused GST exemption to indirect skips. This section sets forth 3 different elections you may make regarding the allocation of exemption. All right, hold on. Let me, because I want to stop early. I'm gonna stop here because I don't want to go too far past it. Okay, so the subheading that we're under, Part 3, indirect skips, right? It's breaking down the form itself. So if we had the 709 form in front of us, we'll be looking at the form and it's telling you each individual box is breaking it down, what to put in that box, right? So in column N, it's telling you about this election. When you see the word election and it's bold, it's basically saying it's something that you are choosing to do. This is, in my opinion. I could be wrong. It looks like to me that an election is something that you can choose to do, right? It says you may elect, so it's a choice. And then it tells you you can elect to allocate the exemption. So this whole thing is about exempting interest from tax, right? And how you can do that properly. That's what these instructions are telling us. Again, I keep seeing the same thing over and over again. Section 2632C, and it said it like 4 or 5 times. So at this point, your brain should be tickled. You should be at this point, you should be looking forward to getting to this section because they keep saying it. So I'm gonna go right into this election. So section, excuse me, my flow dry. All right. Section 2632C provides for the automatic allocation of the donor's unused GST exemption to indirect skips. This section also sets forth 3 different elections you may make regarding the allocation of exemption. Election 1. You may elect not to have the automatic allocation rules apply to the current transfer made to a particular trust. I like that. I like that. Yeah, I would elect that. I definitely would. Election number 2. You may elect not to have the automatic rules apply to both the current transfer and any and all future transfers made to a particular trust. I like that election too. I like it. Election 3. You may elect to treat any trust as a GST trust for the purposes of the automatic allocation rules. You know what, man? I ain't even gonna stop. If you get it, you got it. See section 2632C5 for details. Once again, keep smacking you in the head with it. Go see that section. At this point, you should be running to it. What is it talking about? When to make an election. When to make an election. Election 1 is timely made if it is made in a timely filed gift tax return for the year the transfer was made or was deemed to have been made. Election 2 and 3 may be made on a timely filed gift tax return for the year which the election is to become effective. Okay. To make one of these elections, check column N next to the transfer to which the election applies. You may also attach an explanation as described below. If you are making election 2 or 3 on a return on which the transfer is not reported, simply attach the statement described below. If you are reporting a transfer to a trust for which election 2 or 3 was made on a previously filed return, do not make an entry in column N for that transfer and do not attach a statement unless you are terminating the election. Attachment. Attach a statement to Form 709 that describes the election you are making or terminating and clearly identifies the trust and or transfers to which the election applies. Split gifts. Gifts made by a spouse. See this heading under Part 1. Part 4, taxable gift reconciliation. All right, as we going into another section here. Where we at? All right, we got 7 more minutes. Let me see how far we're going to go on this one. Part 4. That is okay. Yeah. All right. I don't know if I want to break this up. I think. All right. So, split gifts made by spouse, Part 4. That goes with here. This goes charitable deduction. Okay. No, they're separate. All right. Let's keep chugging through. All right. Taxable gift reconciliation. Line 1. Enter only if gifts of the donor. Enter only gifts of the donor. If gift splitting has been elected, Enter only the value of the gift that is attributed to the spouse that is filing the return. Enter the line 2, excuse me. Enter the total annual exclusions you are claiming for the gifts listed on Schedule A. See annual exclusion earlier. If you split a gift with your spouse, the annual exclusion you claim against that gift may not be more than the smaller of half of the gift or $19,000. This is bothering me. Get out of here. Deductions, line 4. Marital deduction. Enter all the gifts to your U.S. citizen spouse that you listed on Schedule A and for which you are claiming marital deduction. Enter the total value of the items in parts 1 and 3 of Schedule A for which the box in column 1 is checked, or column I, is checked. Do not enter any gift that you did not include on Schedule A. Tip: do not enter on line 4 any gifts to your spouse who was not a U.S. citizen at the time of the gift. You may deduct all gifts of non-terminable interest made during the year that you entered on a Schedule A, regardless of the amount, and certain gifts of terminable interest as outlined below. Terminable interest. Excuse me. Generally, you cannot take the marital deduction if the gift to your spouse is a terminable interest. In most instances, a terminable interest is non-deductible if someone other than the donee spouse will have an interest in the property following the termination of the donee spouse's interest. Some examples of terminable interests are a life estate, an estate for a specified number of years, or any other property interest that after a period of time will terminate or fail. If you transfer an interest to your spouse as a sole joint tenant with yourself or as a tenant by the entirety, the interest is not considered a terminable interest just because the tenancy may be severed. All right. Yeah. Life estate with power of appointment. We saw a few references earlier to this power of appointment. So this is going to be that definition. You may deduct without an election a gift of terminable interest if all 4 requirements below are met. Number 1, your spouse is entitled for life to all of the income from the entire interest. Number 2, the income is paid yearly or more often. Number 3, your spouse has the unlimited power, while alive or by will, to appoint the entire interest in all circumstances. Number 4, part of the entire interest is subject to another person's power of appointment, except to appoint it to your spouse. If either the right to income or the power of appointment given to your spouse pertains only to a specific portion of a property interest, the marital deduction is allowed only to the extent that the rights of your spouse meet all 4 of the above conditions. For example, if your spouse is to receive all of the income from the entire interest, but only has power to appoint 1/2 of the entire interest, then only 1/2 qualifies for the marital deduction. A partial interest in a property is treated as a specific portion of an entire interest only if the rights of your spouse to the income and to the power are fractional or percentile share of the entire property of the interest. This means that the interest or excuse me, that this means that the interest or share will reflect any increase or decrease in the value of the entire property interest. If the spouse is entitled to receive a specified sum of income annually, the capital amount that would produce such a sum will be considered the specific portion from which the spouse is entitled to receive income. Election to deduct qualified terminable interest property, that is a Q-tip. So this is an election to deduct a Q-tip. You may elect to deduct a gift of terminable interest if it meets requirements number 1, number 2, and number 4 earlier, even though it does not meet requirement number 3. You may make this election simply by listing the Q-tip on Schedule A and deducting its value from Schedule A. Part 4, Line 4. Checking the box in column I. You are presumed to have made the election for all qualified property that you both list and deduct on Schedule A. You may not make the election on a late filed Form 709. Special Q-tip election. If you elect Q-tip treatment for any gifts and trust listed on Schedule A, then you may also check the column M to elect to treat the entire trust as non-Q-tip for purposes of GST tax. The election must be made for the entire trust that contains a particular gift involved in this return. Be sure to identify the item number of the specific gift for which you are making this special Q-tip election. Line 5. Enter the amount of the annual exclusions that were claimed for the gifts listed in line 4. All right. We had about an hour. Let's see, line 12. I could keep going. Yeah, let's just keep going, because we almost at the end of this section, which is, I gotta check my table of contents here. And this is, 14, Schedule B, gifts. So we're still under gift subject to both gift and GST taxes. We're still under that subheading. So I'm gonna go ahead and just rock out, finish reading the rest of this to get us to the next subheading, which is Schedule B, gifts from prior periods. So finishing Q-tip election, line 5, let's go to line 7. Line 7, charitable deduction. You may also deduct from the total gifts made during the calendar year all gifts you have to do. Let me say that again. Excuse me. You may deduct from the total gifts made during the calendar year all gifts you gave to or for the use of the United States, a state or political subdivision of a state, or the District of Columbia for exclusively public purposes, any corporation, trust, community chest, fund, or foundation organized and operated only for religious, charitable, scientific, literary, or educational purposes, or to prevent cruelty to children or animals, or to foster national or international amateur sports competition, if none of its activities involve providing athletic equipment, unless it is a qualified amateur sports organization. as long as no part of the earnings benefits any one person, no substantial propaganda is produced, and no lobbying or campaigning for any candidate for public office is done. A fraternal society, order, or association operating under a lodge system, if the transferred property is to be used only for religious, charitable, scientific, literary, or educational purposes, including the encouragement of art and the prevention of cruelty to children or animals, or any war veterans organization organized in the United States or any of its territories, or any of its auxiliary departments or local chapters or posts, as long as no part of any of the earnings benefits any one person. On line 7, show your total charitable, public, and or similar gifts minus annual exclusions allowed. Enter the total value of items on parts 1 and 3 of Schedule A, for which the box in column K is checked. Line 10, GST tax. If GST tax is due on any gift which is a direct skip, the amount of the gift shall be increased by the amount of GST tax imposed on the direct skip. See section 2515. If you enter gifts on part 2, or if you and your spouse elected gift splitting, and your spouse made gifts subject to the GST tax that you are required to show on your Form 709, complete Schedule D and enter on line 10 the total Form Schedule D, Part 3, Column G. Otherwise, enter 0 on line 10. Line 12, election out of Q-tip treatment of annuities. Section 2523F6 creates an automatic Q-tip election for gifts of joint and survivor annuities, where the spouses are the only possible recipients of the annuity prior to death of the last surviving spouse. That was a mouthful. Hold on, let me read that again. Hold on. Let me get more comfortable. Here we go. Section 2523F6 creates an automatic Q-tip election for gifts of joint and survivor annuities, where the spouses are the only possible recipients of the annuity prior to the death of the last surviving spouse. The donor spouse can elect out of Q-tip treatment. However, by checking this box on line 12 and entering the item number election. I'm sorry. No, we gotta go back. Sorry, messed it up. The donor spouse can elect out of Q-tip treatment. However, by checking the box on line 12 and entering the item number from Schedule A for the annuities for which you are making the election, that was completely wrong. I'm definitely tired because I'm confused myself now. All right. Sorry about that. Got to read that again. Starting over. Okay. The donor spouse can elect out of Q-tip treatment. However, by checking the box on line 12 and entering the item number from Schedule A for the annuities for which you are making the election, any annuities entered on line 12 cannot also be entered on line 4 of Schedule A, Part 4. Any such annuities that are not listed on line 12 must be entered on line 4 of Schedule A, Part 4. If there is more than one such joint survivor annuity, you are not required to make the election for all of them. Once made, the election is irrevocable. All right, I'm going to stop there at the end of that section because I am thoroughly tired. All right. So that was, if we go into our table of contents, that was the end of the section that is listed as gifts subject to both gift and GST taxes. We are now on Schedule B. So we wrapping up Schedule A with that reading right there. All right. So if I don't have any questions on the YouTube, no comments on the YouTube, and no comments or questions on the TikTok. I don't see no questions on there. All right, bet. All right, y'all. I'm gonna go ahead and shut it out, close it down. Thank y'all for coming out. I appreciate your viewership. I appreciate your interest. Um, man, we all should be interested, but it's not. It ain't like that. So I'm glad somebody is, because like we said before at the beginning of this is not stuff that's for rich people or a certain class of people. This is for anybody that is here and got an SSN or an EIN, or as we saw before, even the IRS and you can have. So this is for anybody who has the willingness to read and understand it and then try to apply it to their life. All right. Y'all be safe. I will see y'all tomorrow at a little bit after 6. I want to say a little bit after 6. All right. Be safe, y'all.